Usually, people perceive high volatility as a bad thing for crypto. Now we are at like all-time low when it comes to volatility, and the market sentiment has never been worse as well. Why is that? Today I'm going to show you the sheet that shows the volatility of different assets and explain how you can turn high volatility to your advantage. Hello guys, firstly Happy New Year to all of you and I wish you all the best in 2023. My name is Željko and welcome to Unsymmetry. For the majority of people that are invested in crypto and other financial markets, when they wake up, one of the first things that they do is check the price of asset in which they invested and if the markets went up or down during the night. These changes in price are called volatility, and volatility can be looked at any time frame, minutes, hours, days, weeks or even months, but usually when we look into volatility we are talking about daily price changes since it makes the most sense. And if you would compare it with the intraday price change, for example, the results wouldn't change too much when it comes to comparing which asset is more volatile, and you would need to look at way more data without any benefits. If you look at the weekly or monthly candles for volatility, you would have a big delay, which is not good for a fast-paced environment as crypto and potentially not even enough data to pull good results. So I will always discuss daily volatility. We are currently in a very rare situation where Bitcoin volatility falls below Nasdaq and S&P 500 volatility. This is pretty much a historical bottom when it comes to volatility. And the main reason is a low trading volume, which is usually followed by subdued price changes. The second reason is the macroeconomic situation we are experiencing, the war, the monetary tightening policy and other factors that bring uncertainty to financial assets. From the sell side, many large holders exited the markets already, and the ones that are in don't have any incentives to sell now. Also from the buy side, they are also waiting for some signs of a market reversal to buy back their positions. Usually after every calm period we have a spike in volatility. This can bring the price in any direction, a new lower low which would be below 15.5k, a relief valley, or just a bull or bear trap with the price staying in place over a longer time frame. Regardless of what direction crypto takes, it's critical to understand the current level of volatility in crypto markets and how you can use this to your advantage. Knowing when to buy or sell is key to maximizing profits during periods of high volatility. Also, currently we are sitting in a situation where we have a low trading volume in a combination with low volatility, and this can be dangerous for the traders. First thing is that you don't need a large amount of volume to move the price in any direction, so it is much easier for big players to manipulate the markets. And if you look at the recent periods, we have a lot of short and long squeezes that are trying to liquidate as many people as possible along the way and accumulate more assets for themselves. The second thing that is dangerous is the trading patterns often don't play out as people expected. Instead, we end up in a situation where we just move in price for a certain amount and stay there, as it happened recently when the FTX fell. So people try to call patterns like rectangles, falling wedges, double bottoms, and instead often it is best to wait and see what plays out and then make the moves. In this way, you are dodging unpredictable moves and waiting for more certain opportunities. Let's look into the charts. So this sheet is another piece of data that I wasn't able to find anywhere. You can look for the volatility of specific asset, but I wasn't able to find the comparison chart or anything like this. So if you look at the sheet, you can see that the third column represents 30-day volatility, fourth column represents 90-day volatility, and the last one represents annual volatility for a specific asset. If you check numbers, you can see that there are huge variations of volatility between assets, and some of them might not be even relevant, as PAXG for example, since it's backed by gold, so obviously it will have much lower volatility, as you can see. Also, since you have three columns, you might be wondering which one you should really focus on. Honestly, even though that most of the people look for the annual volatility, I prefer to look for a 30-day and 90-day volatility, since by that we eliminate the drop from the top of the market to the bottom of the market. If we include annual volatility, the most volatile currencies are often the ones that decrease the most in price, or the ones that had a lower peak during the previous bull run. And since the sentiment is completely different now, I want to see how assets perform during this capitulation phase. Also, you can see that Bitcoin is one of the least volatile assets, and if you look at the bottom part of the sheet, the majority of the coins that are here are the ones with the higher market cap. The currencies with high volatility are most often ones that experience a strong move to either upside or downside, or the ones with a lower market cap. Also, if the 30-day volatility is much higher than the other two, that move up or down probably happened recently. One of the goals is to identify if that big move already happened or we are just taking off. People most often see volatility as a danger, but instead as a trader you should see it as an opportunity. So usually we want to use volatility data in confluence with other data to pull dedicated conclusions. For example, I look into this data and altcoins accumulation data, which I showed in one of the previous videos. You can see it here, and also in combination with support and resistance levels to identify the coins which are about to break out. I managed to do that with DOT and Matic during the previous bull run, for example, and this strategy is something that is best suited to identify the start of the bull run and during a bull run in general. In bear markets, you can also look for spikes of volatility in confluence with coins that slowly started decreasing in price in the sheet from the previous video and breaking the support levels for identifying the breakdowns. So if you experience a break in support levels, I expect a bigger breakdown for Mana and Near, for example, in comparison to most of the other coins at this list. Also, I mentioned in the introduction video that I developed a grid trading strategy which pretty much brought me 3 to 5% monthly returns, and it was completely based on identifying assets with the highest volatility that are staying in a tight range without big oscillations. The current market situation is pretty good for this in terms of staying in a tight range for a long time, but not that great for a volatility perspective. Also, often low volatility is perceived as some kind of stabilization of the market, so it is great if you have a stable income from other sources during the bear market. You can accumulate assets slowly and take profits once the bull market occurs. The volatility can be used in many different ways, but usually if you are a trader, you want to place your take profit and stop loss positions further from the entry price in comparison to lower volatility assets when it comes to the percentages, or just use the lower size positions that you are trading with. So for example, if you have a $1,000 position long for 10% up and a 5% stop loss, you would get $100 or a lose of $50. While if you would trade an asset with lower volatility, where you would place a long position at 5% and stop loss at 2.5%, you would need a position of $2,000 for a same potential return. So these are just some examples. Volatility is one of the things that you should always be aware of because it shows you how fast can you expect a price change to happen. If you're an investor, of course there are different types of investors, but during times of uncertainty you might want to focus on assets that have lower volatility like Bitcoin or XRP, for example, and if there are some big positive events coming in combination with low volatility like Litecoin halving, that's a bonus in my opinion, and definitely a chance to get good returns in the long run. After a period of low volatility, usually we can expect a huge breakout in any direction, so either we're gonna see another leg down or a short relief rally. Even though we can see both high and low volatility in both bull and bear markets, high volatility often comes when we are either at the top of the market or at the bottom of the market. Often high volatility indicates that there is no real confidence in the market direction. A great example of this is periods when CPI and inflation data are announced, since we can see the price going up and down pretty fast within the tower, and in my opinion it's best to stay out of a trade at these times. Also, when you're acting on the news, make sure to be aware if the news is fully priced in to some point as Litecoin halving that I mentioned in this video, or not priced in at all. So volatility is just one of the tools for trading and investing, but it is a very important one. Be aware that if the market goes in the opposite direction of where you wanted, the volatility acts like a multiplier for your losses. If it goes in the direction that you predicted, it's a multiplier for your gains. Also, often high volatility correlates with local lows and local highs, so often the price reverses, at least in a short term, after the volatility peaks. So it's one of the things to consider when it comes to identifying market trends. These are just some things that you should take into consideration when it comes to volatility, and I tend to do monthly updates on this where I will discuss some other things to take into consideration. So a lot of people made many wrong decisions and decided to quit the crypto once for all in 2022, while many are recovering from the losses and are in the healing process now. I would like to congratulate you on surviving 2022 and for watching this video to the end as well, and I hope that I am gonna be able to help you to mitigate as many mistakes in 2023 and multiply your portfolio in the future. If you find this video valuable, please comment on what you would like to see in the next one and subscribe for more content. Thank you and have a wonderful year. There is always a second chance on the train. If you made many bad decisions in 2022, whether it comes to crypto or life in general, you will have many chances to fix them and make things better. So, when these chances come, don't hesitate, use them.